delighted to have a couple of interesting talks on using psychometrics. So thinking about data in making loans and investments. And we'll start with Rachel Cassidy, who's now at IFC.
Thanks so much. So thanks so much to the organizers. It's been a really fantastic event. And thank you all for still being here. I know it's 3:30 on a rainy Friday afternoon, so I'm going to try and keep it engaging. I'm mainly going to show you pictures, I promise. No regression tables or literature reviews. And if you're interested in that stuff, then the paper is online. So please do feel free to take a look. So this is joint work with Salman, with Marcus and Sri, and I was until recently at the World Bank, so that's where this project was housed. But as Chris mentioned, I'm now at IFC, and we are building out a program of rigorous impact evaluation there. So happy to chat more online, offline even, about what we're seeking to do. And so what motivated us to start this project is that many of you will know women-owned firms worldwide are typically smaller and less profitable than their male-owned counterparts. And we care about that not just because we care about equity and women's empowerment, but also because we care about efficiency and we care about economic growth. Also, from financial institutions' perspective, this is a potentially profitable market segment that's not being fully tapped. And so there are many reasons underlying this. Today, we're focused on finance. And specifically in this study, we're going to focus on collateral. And so women are, to a much less extent than men, owners of collateral. So their names are not typically on housing titles, on land titles. They're not typically the registered owners of large fixed assets such as vehicles. In some cases, they're accepted by MFIs to collateralized lending. And so we're going to try and address that in this project. And the reason we do that is that this audience will be very familiar that there's gender parity when it comes to microfinance. Actually, quite a lot of joint liability, more traditional microfinance schemes target women. But when you start to look at slightly larger ticket sizes, then you see the balance shift the other way, okay? And we're looking at women here who they are micro-entrepreneurs, but they are not subsistence. They're not by themselves or with kind of one employee. They have 2, 3, 4 employees, 2, 3, 4 years in business. And I think segmentation is really important when we think about what is microfinance, what are micro-entrepreneurs. They're very different groups of businesses, and their financial needs are different. You might even think of it as meso-finance. They need a few $1,000s, not a few hundred. And we're building on work here that shows that psychometric testing can be used to predict repayment for SME finance, MSME finance. That comes from Latin America. That also comes from sub-Saharan Africa. Gharad's going to talk about predicting returns to loans, but here I'm just going to focus on repayment. So what do we do? And I promise simple slides. We do kind of two things. Firstly, sort of a proof of concept, and secondly, an RCT, a randomized controlled trial. So we work with an MFI in Ethiopia, and we introduce psychometric credit scoring as a substitute for collateral when they are granting these larger individual liability loans. And I want to be clear, we're not saying have a psychometric credit scoring process and take away all of your due diligence. That's not what's happening here. It's just replacing the collateral. They're still going to do documentation checks, business appraisal, and so on. And the reason we do a randomized control trial is that we want to show if you introduce a product like this, do you actually expand lending to MSMEs? Or is it the case that women who qualify for this product would have got access to finance anyway? So that's why we want a control group. We want to see what would have happened if we hadn't have introduced this product to this same pool of borrowers. So just to be clear and fix ideas, what's psychometric credit scoring? So when I say psychometrics, you might think of like, are we doing Myers-Briggs? Are we measuring the big five? It's different in this context. A woman who wants to borrow can turn up at a participating MFI branch. She can take a quiz. It's on a tablet you can see here. And it's measuring a bunch of traits. It's taking not just her variables, so her answers. It's also taking her metadata, so how quickly she answers, where is her cursor on the screen. Apparently this stuff is also predictive. And it's trying to predict one thing and one thing only, which is her repayment, okay? So as I said, you might be interested in predicting returns if you're thinking about targeting, especially subsidized lending. If you are thinking about more equity-like projects, then you're going to think about predicting returns. But here, the MFI just cares about repayment, and so that's what we're trying to predict. And the way that the technology in a sense, models this. It feeds everything into ultimately a big algorithm, but it's thinking about ability to repay, so whether her business is going to be successful, but also willingness, conditional on ability, so traits such as honesty and conscientiousness. It's calibrated against a base model from Kenya. We also piloted this with another Ethiopian MFI to train the algorithm on their data. They're doing collateralized lending, but it also predicts well there. And as we roll the project out, it's going to continuously train over the borrowing data. So in principle, it's going to get better over time. So we embed this into a product, and the product is, and here's just to give you a couple of examples of the questions. So some of them are a little bit more personality trait type questions, so measuring things like how much she believes that results are due to hard work versus networks. Some of them are more ability and budgeting tasks. Actually, what I'd like you to take from this is that, firstly, there's a lot of questions. Secondly, as I said, the metadata feeds in. And thirdly, a lot of them, it's not very clear what the desired response is. And so you might instantly start thinking, oh, is this going to be gameable? I fill out 30 questions, I get a loan, I tell my friend, look, you just got to answer like this. It's not obvious, and even, I mean, it's a bit of a black box. The tech firm we work with, it's a proprietary technology, but some of the results they share with us, it's kind of surprising which ways these predict repayment. So we embed this in a product. It's called WedUpX. So we ran this trial under the auspices of a big government of Ethiopia project called the Women's Entrepreneurship Development Program. And that offers trainings to women. Women can come and register at a one-stop shop, and they can access a range of trainings. And if they have collateral and under certain conditions, they can access large collateralized loans. And so these are about $12,000. And so when you compare that to what's out there in the microfinance market, you're talking about like an order of magnitude larger. So a first-time borrower might get a few $100s up to maybe $1,000 in a typical microfinance setting. So here it's like 10x. And so we introduce, under this context, an uncollateralized product, and it's called WedUpX. We work in economics, not in marketing, so these aren't perhaps the fanciest names, but there you go. These are large loans still, but they are smaller than those collateralized loans. And they are uncollateralized, as I said, and the interest rate is a few percentage points higher. Why? Well, guess what? They're uncollateralized, there's more risk. But also we're trying to induce what economists call a separating equilibrium, where you think of self-selection. If you have collateral, then the first product should be more appealing to you, and so you should select into it. You can access more, it's cheaper. And so the idea is to encourage only women who don't have collateral to come along and take this new WedUpX product. Okay, and so we advertise this via these kinds of flyers, again, really rustic, but they do the job, and there is interest in signing up for this product. Both products have a similar term, 12 to 24 months, and they're targeted, as I mentioned, at these growth-oriented women entrepreneurs. And so when it comes to the sample that sign up for our trial, they are average age 36, they're secondary educated, they have 2 to 3 employees, they've been about 3 years in business already, and they are mainly in trade, in services, a few in manufacturing. And you can think of, I mean, earlier the example was food trucks. In Ethiopia, it's more like I visited some of these projects, and there are women who have a cafe, it's successful, and then one woman had bought the building next door because she wants to double the size of her already very busy cafe. This kind of business. All right. So as I say, we embed this in a randomized controlled trial. And so we have 360 women who show up and take the test. And then the MFI agrees with the tech company there's a cutoff score. And if you're beneath that cutoff score, you're automatically out. You're not deemed eligible. If you pass, so 260 women pass that cutoff, as I said, they still go through some aspects of due diligence. So they get their documents checked, and they go through a business appraisal. It's pretty light touch, but still, it's binding here, because half of those women who pass the test still don't get a loan based on that phase. And we actually show in the paper that those women go on to do worse than our control group. So women who pass that due diligence but still don't get the loan, they are better than those women who don't pass due diligence. So this is still carrying informational value. And then if you pass both steps, the test and the appraisal, you're in our RCT sample, and half get the loan, half don't. So those of you who do RCTs, who know RCTs, might be looking and thinking, that's a really small sample. indeed, we aim to have about 10 or more times this sample size. Unfortunately, it ended up as more of a pilot because guess what? COVID had other plans for us. So we began in 2018, but really this ramped up in 2019 towards the end. As a bit of a sidebar, perhaps it makes sense, but getting the MFI to get all its processes adapted to do this kind of experiment took a while. So at the end of 2019, we started ramping up lending volumes. Then COVID hit early 2020, and we stopped granting new loans under this project. We went back during COVID. We did a phone survey. About 2/3 of the businesses were temporarily closed. And then we came back in September 21 to do an end line. We managed to trace most of the women. If you know Ethiopia, this still isn't like a business as usual context. So it's just after the last peak of COVID, and it's also just after elections. So when you see the results, it's still a macroeconomic period of instability, you can say, but it's not COVID. And so I just want to highlight 3 results in the interest of time. You can see plenty more things that we look at in the paper. The first one is, the sort of first order question we wanted to answer. Does this increase access to borrowing, or did the control group just go and borrow elsewhere anyway? And we see that it really does increase access to credit. So 60% of our control group do go on and borrow over that 3 years. A lot of that's informal from family and friends. But this goes up to 90% of our treatment group. And in terms of formal borrowing, so in the orange bars of the control group, about 40% of the control group do go on and access formal borrowing. A lot of that is coming from some MFI lenders introduced that you can have a guarantor rather than collateral. Some are using collateral that tends to, it looks like in the data, belong to their spouse or another family member, but they're using that. But that jumps to, again, nearly 90% of the treatment group took a formal loan, and they actually borrowed less from their family and friends, so you might think of that as kind of a second-order benefit, that they're less having to rely on that informal credit. Then the second results, if my slides are still with me, sorry, the clicker's a little bit behind, is that this access to credit helped businesses to survive. And this ended up being kind of the primary outcome given everything that happened. And so you can see that in the control group, so the orange bars, only 2/3 of the firms were still open after 3 years. And that increased to 83% in our treatment group. So put it differently, 1/3 of the control group closed because of all these shocks and other factors. And we're halving that closure rate with access to credit. That might still sound like a high closure rate, 17%, but that's kind of business as usual in a 3-year period in this kind of setting. The control group don't all exit entrepreneurship. Some of them open a business in a new sector. And we looked because we wondered, might paradoxically we have kept women stuck in their first business when actually they needed to adapt? Maybe they wanted to make face masks or hand sanitizer, but we don't see much of that in the data. So those who stay in business are still profitable, and there's not a big trend as to what sectors people are moving in and out of. Did we help firms to grow? Well, there's no clear evidence, and that's partly because we have a small sample, partly because of other conditions. If you ever measure profits, they're very noisy. So you can see the blue bars kind of look higher than the orange bars, but that's not statistically significant. So no impact that we can claim on profits and growth. But we can say there was a lot of worry at the time that schemes like this might be channeling credit to firms that are actually unviable. They're just keeping the lights on. They're zombie firms during COVID. We're just keeping them open. We don't see that. These firms are, on average, making a pretty healthy profit, conditional on being open, and there are very few zeros or low profit firms. So what to take away? I'd like to say that with this pilot, we provide a partial proof of concept. So proof of concept that we had an MFI willing to do it. We did it. We had some positive impacts. On the flip side, there was a high fixed cost of developing this technology, not just in money, but also in time. It takes time to train on a population. And that's an important question to think about in scaling. And I think we'll talk about scaling later in this session. But, there are some almost public good aspects of this. Imagine if I can get certified and then go down the road to another financial institution and say, hey, look, I have a high score. And so we're going to need to think about that in scaling. Are there cases for subsidization and so on? As I mentioned, other parts of appraisal still mattered. But what we're excited about is that there has been a lot of demand once we've had this demonstration effect from other MFIs in Ethiopia. We are scaling up 2 pilots at the moment, or rather my colleagues back at the bank are still working on those scale-ups. What about repayment? This is a question I now always ask in seminars on finance, because often researchers, we're tricky and we'll present you some lovely results on household outcomes and we won't tell you about the default rate. So here you are for transparency. Actually, these uncollateralized loans were doing really well prior to COVID-19. So the BADs, the defaults, so you can look at PAR 90 and so on, they're doing really pretty well. It's very, very low default rates and very comparable to the collateralized loans. COVID hit, things got worse. You're still talking single figures in terms of default rates. There's not really a good benchmark in terms of collateralized lending because that really stopped as well at the time. And so we can't really say how much is due to it being uncollateralized versus just COVID per se. And so obviously we need more evidence in a more business as usual environment. And we need more evidence on whether this can really support firm growth. The question, and I think Gharad's going to take up the baton talking about this, it then comes to targeting, especially when you're granting larger loans. How can we target the firms that have capacity to grow and that might take on new employees? And I think that's another key point here. People sometimes ask, why are we interested in this above subsistence segment? Like, shouldn't microfinance be about helping people out of the poorest of the poor rungs of society? But I mean, these women are already taking on 2 or 3 employees, and with growth, might they have the potential to take on more? Not every woman or individual wants to be an entrepreneur. Many might want to be employed by somebody else's business. And more broadly, we are thinking about other ways technology can expand access to finance. So we heard about revenue-based finance in the previous session, and colleagues at the bank, at the Gender Innovation Lab, are also piloting revenue-based finance in Ethiopia, and a host of other ideas. So happy to talk more later, but I think that's 15 minutes. Yeah.
Great. So there'll be a slide that says big loans to small businesses in a second, and I'm going to tell you about a project about trying to get MFIs to increase the sizes of their loans in the hope that I can take a small firm and start it on the pathway to being a small to medium-sized firm. And so that's why big loans to small businesses. The organization that we managed to convince us to try and do this is Alexandria Business Association. And I'll talk about how we got to work with them a little bit. They are the largest MFI in Egypt, about 42,000 clients, and their average loan size is something like $170 US. This is quite old. It's sort of like 2014. This is an ongoing and very slow project. Okay. And they sort of do what a traditional MFI does. You sort of start small and you get bigger and bigger, but eventually you just hit a threshold at which they're not willing to go above. It's an Egyptian setting, obviously, and it has some uniqueness. If you default, which means you never repay the loan, and the ABA reports you, that's prison. So it's strong incentives to repay here. And the attainment rates in the end are typically 100% here. So you need to keep that in mind. So some more about the setting. And I think this is common everywhere, and it explains why we're interested in trying to expand the size of loans. So MFIs in Egypt offer loans from about 1,000 to 5,000 Egyptian pounds. This is not a legal binding top at 5,000 pounds. They're legally allowed to go up to 150,000 pounds. But a bank loan wouldn't start till about 50,000 Egyptian pounds. And to get that, there are many more legal requirements. You need to be a formal business. To be a formal business in Egypt, you need to have a registered address, and that rules out a registered address separate from your home address, which is going to rule out a lot of firms and things. And that gap is very, very large. And we're interested in how you might go about trying to fill that gap in the credit market. So what's ABA's explanation for why this gap exists? And it's really a supply-side explanation, which is that they are just very worried about the risk of lending over, say, 10,000 Egyptian pounds. This is reflected in the incentives that they give to their loan officers, and their loan officers are fully incentivized around default rates, despite the incredibly low default rates. Right? Nothing about the size of their portfolio or anything like that, just defaults. It should be noted that the risk that they think is relevant here is not entirely their own financial default risk. It's also the well-being of their clients. They do not want to put someone in a position where they take a large loan, expand their business, lose their business, and cannot repay their loan. This is common in my experience for MFIs who see themselves as having a poverty alleviation target goal, and so pushing people into poverty is not going to be great. Okay. And this ABA was the third location we tried to make this work. Chris continued to fund us as we moved through South Africa and the Philippines. And we got a long way in both those cases in trying to convince banks, MFIs, to give big loans. But in the end, they would always pull out. No, the risk of this is too large. We're just not going to do this. And in the end, we managed to convince ABA because we managed to find a local partner who was willing to give a guarantee so that we could experiment on giving these larger loans. Okay. Now, I want to think a little bit about the type of risk that ABA is thinking about here. There's sort of two types of risk. One is where I just can't predict. Some people are going to open up firms and they're going to fail, and some people are going to do well, and I just can't find them. That's not something we can do very much about, and if that's the case, then ABA is correct to stop lending. There's no societal or ABA benefit to that lending. On the other hand, the risk may be predictable, either by the bank or by the client. The client might know something about how they're going to do. And you could try, that then invites the question of if ABA thinks there's risk here, can we try to find the firms that are going to do well? For us, that's the firms that are going to do well for themselves. They're going to expand their business, they're going to earn profits and be able to pay back ABA, not necessarily just lost default. And you can try and find those in a range of different ways. You could try and help the borrower to understand their own business better, to select better into whether they want to borrow, and we've got some projects around that. But you could also do it from the lender. For example, you could have a loan officer who spends an intense amount of time getting to know a business, as we've heard about here. That sort of thing is incredibly expensive for these sorts of size loans, as we've already heard. Or you could do something that's just attrition-led. Expand lending, the bad firms will go out of business. Who cares? Only the good will survive, and away you go. What we're going to do is we're going to do some psychometric testing. I'll tell you what the questions are prior to getting a loan. We do not have a model ex ante like Rachel did. Instead, we're going to run a randomized control trial. The control group gets a slightly larger than business as usual loan, 2 times what they would have been lent without our experiment. And the treatment group gets a 4 times larger loan. This allows me, as you know, to estimate the causal effect of the large loan. And I'm going to combine that with the psychometric data and some fancy machine learning stuff that we could try and talk about to train a model that finds who has the largest causal effect of the big loan and who has the smallest causal effect of the big loan. That's our goal here. Okay, what is the psychometrics? I could talk forever about the psychometrics industry, but let me just tell you what we did. So we've got a 50 Likert scale statements. That's on a scale of 1 to 5. How much do you agree with the following statement? And there are things like, I will do anything to get what I want. I see patterns and connections where others don't. I am a natural risk taker. It's very hard for me to read these things and understand why the psychometrics people think these are relevant, and they have a very different approach to understanding these things than I do as an economist. But we wanted something that was already in the appropriate language. This existed. These guys were willing to share. And we're going to just train our model on what turns out to be just a very large data set because of this. And ML methods work well when you have just lots of facts about people. So, what happens in my experiment? The first thing is that this missing middle of credit is not entirely, at least, about demand. So this is the amount of debt owing to ABA as it goes on over time since we give our experimental loans. Red is the control group, blue is the treatment group. If we give you a big loan, you borrow. So we can rule out the missing middle is about firms not wanting to expand. That was one of our goals. If we offer you big loans, do you take them up? Now I'm going to get ugly regression tables, and I'll try and tell you what they say, and I apologize. This just says that on average, as we find in a lot of the microfinance literature, these loans just don't do very much. That's consistent with everybody not getting very much out of it, but it's also consistent with this ABA view that this is very risky. Some people did extraordinarily well with their loans, and some people went out of business when they tried to expand. How do we know? And you see a little bit of an inkling of a heterogeneity here, because there is a positive causal effect on consumption. What would we think would happen? The firms that did well, they keep their own money and consume a bit more. The firms that did badly, their friends and their family come in and soak up that loss. And so you cut off the left tail of the consumption. The third thing is, and I think, this is not what we make out of the paper, but this is profitable for the lender. So what does this show? It shows that the firms that got the very big loans were a little bit slower in their repayment. But eventually they repay their loans, they're not in default, and they don't go to prison. But they do pay ABA a lot of late fees. And those late fees are far more than ABA's cost of credit over the period that these were late. So ABA actually earns money out of doing this. Somebody said earlier, should the DFIs be in the position to just guarantee some experimentation by MFIs? And that's one thing that we've done here. We've done a guarantee, said you can experiment with a larger loan, and we'll back you if it goes terribly wrong. Afterwards, they've discovered, oh, this is not so bad. We're okay with this. And I'll tell you more about what they do in the long run. This is the main point of the paper. These are the treatment effects for different quartiles of firms. These are the firms that do best. They're found with magical machine learning stuff. They increase their profits per month by about 5,000 Egyptian pounds on a base of about 8,000 Egyptian pounds. They come close to doubling the size of their business. They got assets, they employ more people, they grow. These are the worst performing firms, and they do almost as badly as these firms do well. They close their businesses, they fire employees, etc. Very strong heterogeneity here. And then, in principle, with our trained model, you can find these guys. Right? These are guys that gave consistent sets of answers to these 50 psychometric questions. I'll talk about whether you would want to do that in a second. 5 minutes left? Oh, I'm gonna get through everything. Yes. This is trying to do the same exercise without the psychometric data and just the facts that ABA has from their ongoing relationship with the firms. These are things like self-reported revenues. What do you report to ABA? How long have you been in business? How many workers do you have? What are their wage rates, etc.? And using just that data, we find certainly no statistically significant evidence of heterogeneity, and the treatment effects are not very large at all. So you would need this sort of psychometric data. To us, this also says something which people agree on in this room broadly, but I was a little surprised about, which is it means you need to know about the entrepreneur, not about the firm, in order to predict who's going to do well and who's not. Finding 6. The loan officer incentives at ABA are all wrong. So I told you that they try to prioritize lending to firms that won't default. And that could be in line with which firms are going to do well with the loan, but it is not. They systematically predict that the firms that do very well will have an increase in their default because of the larger loans, and that's relative to the firms that do badly. So the loan officers are completely wrong, and there's no evidence that the firms that do well with their loans in terms of their profits increase default rates by more. Okay. That's mostly what we found. Here's what happened to ABA, and it's like sort of a glass is half full, half empty for me. So we convinced ABA to do this experiment. We needed to give them a guarantee to do it, but afterwards, They saw the data. They were very happy. They changed their credit officer incentives to be around providing a larger loan portfolio that performs well, rather than just default rates across the portfolio. And they've continued on with the larger lending. Some evidence that experimentation is good for firms. They do not make use of the psychometric testing, much to my sadness. In some sense, why not? We cannot go from what we've done here as an academic piece of work to a model that I would happily put on an ABA computer and a set of questions that I'd be very happy for them to use. I don't have a commercial product to give them. We have proof of concept and a paper, which is where my sort of incentives stop, and somebody sort of would need to take it from there if it wanted to go further. Okay, so some summaries and conclusions. So risk in business expansion may lead to this missing middle in credit. And indeed, in our data, we find no average effect of expanding lending from MFIs to a slightly larger level, consistent with either nothing or risk. The risk that we do see, and I want to highlight this again, the risk is predictable. You can ex ante find out who's going to do well with a loan and who's going to do badly with a loan. I haven't emphasized it, but it turns out if you look at our psychometric data, it is people who are very self-confident who do badly. In retrospect, this might be obvious, but I think if you looked through the psychometric tests beforehand, you might have thought, oh, the people who are self-confident are the ones who are going to be the great entrepreneurs. So it's a little unclear to me. Psychometric testing on the basis of banks and well-made products that do this for banks might be a way to funnel money to better borrowers. In our data, that would sort of completely solve this why don't microfinance loans really lead to big growth? It's because you're not funneling the money to the right people. Would I do that right now? No, you'd want to do quite a lot more testing. And I think the question that came up here earlier of, can these questions be gamed? If enough people go through this same testing, do they eventually learn? I'm unclear on whether they would or they wouldn't, but I'd be fascinated to find out the answer. So, thank you very much.
Great. Yeah, you put that there. So, so let me just make a couple of comments, and then I'm gonna open it up. So one, if I reflect on the day and how this session kind of fits in the day, I mean, one of the issues here is about data and whether it's worth gathering the data. So you Rachel talked about how costly in a sense it is to implement this, and is it going to be worth it? Now it's fair-sized loans, so maybe it would, and it's fair-sized loans that if you could get the right lenders, maybe they'd be repeat borrowers, and that cost gets amortized over time because you've gotten that. So I guess a question in this is that goes beyond the psychometric data to just data in general, is when is it worthwhile to try to do these sort of ML type sort of exercises? We know from the research that's out there that heterogeneity is key in a lot of this stuff, and I guess when the sessions we had on the session we had on venture capital, the other thing I think that comes across there is that you sort of say, well, they may or may not be doing formal psychometric testing. I think if you go look now when you hire CEOs and you hire executives and things like that, increasingly firms are doing formal psychometric testing of candidates. There is more of that being, and I don't know to what extent venture firms and others are doing that as part of their understanding the individual, understanding the entrepreneur. But it seems possible that you could do that. At least it sort of says that informally, when I have discussions and conversations with the entrepreneur, I'm trying to understand, is this entrepreneur the right person to bet on, the right person to invest in? I'm informally doing some sort of psychometrics in a sense. I'm trying to understand what their motivation is, and so a question is that enough, or would adding on sort of more formal psychometrics be useful? And again, if I think about hiring key executives, of course, you do the same thing. You do interviews. You have a whole series of process. You run them through a bunch of different scenarios, exercises, things like that. That's kind of an informal psychometric testing. But then you also increasingly do formal psychometric. So when the stakes are high enough, it's worth paying the cost. And the question in any of this is whether whether there's a market out there, whether it's the size loans that you did or that you did, is there a market out there in a size of loans where it's worthwhile to pay the psychometric, the costs of doing formal psychometrics, and is it, if you did, would that help? The other thing I think that comes from your paper, Gharad, that I find maybe a little troubling in a sense is that because this was profitable for the lender, they don't really care that graph you showed that says predictably ex ante, I can tell you who's going to lose from this and who's going to gain. There's heterogeneity there that if we thought about the social outcomes of this, you certainly would want to use, and it's not apparently in the interests of the lender to actually make use of that. And I guess we could reflect on that. That seems maybe a bit troubling. And by the way, it was 4 locations, not 3. You left Kenya off the list in the search for somebody who would do this. Which I would say, by the way, is interesting, because it is, finding an MFI who was willing to do this, even fully funded and fully subsidized, was really challenging. Getting somebody to sort of be willing to take that risk in a fully funded project was quite challenging and took quite a long time. Persistence and grit and all kinds of other psychometrics in the research team there that we can point to. So let me stop there and open it up. I guess I'd be particularly interested in hearing comments from practitioners who are making decisions, lending investment decisions, about, in the process of finding the right people to invest in and deciding that's the right person to invest in. How do you think about psychometrics, whether it's informal psychometrics or formal psychometrics, in these sort of personality kinds of things? So I could think about the right entrepreneur as being someone who has the right skill set or the right network or the right connections, the things that aren't psychometrics. Or I could think about them being the person who has extreme confidence, maybe not with your results, but or that has certain characteristics. And that's what's important. And I in the case of characteristics, I could either test those formally or go with sort of my judgments about whether that person meets those characteristics. And I'm curious about how, when you think about investees, how you think about those kinds of yeah. So let's.
First of all, thank you both for the presentations. Very, very interesting. I have a question, because what you're doing does sound a bit like a black box. You mentioned it yourself. You didn't, but it's still the same black box. It's an experimental phase, and as you express it, we're not replacing much of the lending process. We're adding on, but eventually you might want to have your psychometric testing be more prominent in the lending phase. You want to start reaping efficiencies and changing things in the process. And have you thought about that? How do you take a black box, which the loan officers don't understand and the clients, let alone, don't understand? How do you take that and implement it? And this is not necessarily because you're microfinance institutions, you're looking at a lot of small clients. You're not looking at the individual entrepreneurs. You're going to implement this on a big scale. And there needs to be buy-in from the institution to do this. And I think that's very difficult with these kind of technologies because nobody understands it. And the loan officers are afraid of their job or what have you. There's so many reasons that this is going to give you problems. So any thoughts on that?
I mean, I have broad thoughts about culture in response to this question and in response to Chris's question, which is like, I agree with all of these things. It's very difficult to imagine loan officers who've been brought up thinking that they look into their client's eyes and determine default risk and that's their goal, to have that replaced by a tablet. I love your tablet and it makes things very, very easy, and that they're going to want to do that. And cultural change within the organizations is just extraordinarily challenging, I think. And that's also my response to your comments about ABA wanting to continue on with this, despite the fact that they know that it's sort of not necessarily great for all of their clients. That's a cultural issue at the sort of bank level, and those things are extraordinarily challenging. What I do think is, as I think I started to say, is it becomes that cultural problem remains, but it becomes a relatively smaller ask if what you're handing off is a well-formed, well-tested product. That's why I love this app. And it's sort of something where the client just sits down. It doesn't take a lot of loan officer time because in principle the client can do it alone, et cetera. And that becomes much cheaper for the bank. I also, this is partly what I think about your question about the cost. The development of that app is a public good in all reason. It is it's excludable, but only because we try and hide it. And it's non-rivalrous because once I've developed it, really the cost of rolling it out for the bank is extraordinarily low. So I think that, the organization that should be paying the cost is something central and then sharing it. Otherwise, you're going to have the problem where it's only sort of slightly larger for lenders that could actually make use of these products. Those are sort of thoughts on the cultural issue, but also what an actual way of making this happen is. And developing those products, at least for our product, is actually very challenging because you can't train it on just existing data. You have to train it on an RCT. So that's going to be a huge difficulty.
Yeah, I'm happy to add a couple of points. I agree with all that's been said. And I think depending on the setting, so it's something that might be declining with cost and with the scale of expansion. And so definitely if you're the first to introduce psychometric testing in a particular context, then there's a long period of adapting the model to the local context. Whereas once that's already there, once questions are validated, once models have been trained, then for the nth lender to use that technology, I think it's going to be a lot lower cost. So maybe the case of subsidization isn't permanent, but at least temporary in the initial stages. Just sort of to broaden it out a bit, I think, in a sense, our study is about psychometrics, but really, on the other hand, it's about collateral, right? And so I'm not particularly wedded to it having to be psychometric testing, but something where we can use digital footprints and so on to substitute in reassuring a lender in terms of lowering collateral requirements. And so I think at the other end of the scale, this is something that's being done organically for much smaller ticket sizes. But when you look at like mobile lenders and they're willing to lend just on the basis of mobile footprint or digital footprint and so on. So I think maybe to add more questions than I answer, but we can think about it in that context as well. It doesn't have to be this very specific technology.
I guess can I just ask though, if you took this as a public good and you said we're going to do this once and then everybody's going to use the same instrument, don't we pretty quickly figure out what it takes to what the answers are that are going to get me the loan?
There's a testing guide you can buy online that tells you how to answer all the psychometric
Yeah. So that's the Economist's response, and I'm wary that we are often wrong. I take the point, but I'm not 100% sure that it's true. I presume everyone's done one of these psychometric tests from an HR department at some time.
Myers-Briggs or something
Yeah.
like that.
And like it's really challenging to work out what on earth they're after. Now that's partly because in the HR context they've said we want a good team player or we want a driven individual, and you don't know what the HR department is found for. So that's that. I guess you're saying this gets slightly different if every bank is using exactly the same thing.
And what the stakes are in a sense. So that's as you say, it's not I'm doing this infrequently and I'm
There's additional weirdness here as well, remember though, because what we're saying is that the group of people that we would plan to deny credit to, we have good reason to believe that they are not going to enjoy taking out that loan and expanding their business. It's going to be bad for them. I don't know how that changes the incentives to cheat on this test, but you're essentially saying to them, look, our testing suggests your business is just fine at the size it is. Why don't you continue on as you are? I don't know whether that changes things. I do want to raise one other thing quickly, which is if you look at our data, there's these weird things which we should all be concerned about, which is women would be more likely to be excluded under our criteria. And you cannot get rid of that by just not looking at gender. So like I exclude gender from the training set would be one thing you could do. But that won't solve the problem because women systematically answer these questions in a way that suggests they're going to do badly. And we cannot determine whether that's just because women systematically answer the questions differently and we're training a model on a male-centric thing and we're predicting this woman will do badly but she won't. So those sorts of things are also incredibly challenging as they are across all of this ML kind of domain.
Patty, you have it online. Yeah.
So quite a lot of questions online, but just the first one that came in was to Rachel. I think my mic's. And it's whether you have a sense that what's really being tested for here is, I guess, like moral hazard. Is it willingness to pay, or is it ability that you think that these tests are picking out?
I mean, they are in principle modeling both, and so as I said, it is a bit of a black box because it's a proprietary technology, and that's why that's how the tech company makes money. But when you look at like the long list of traits that they claim to measure, it's a good balance of both, I would say. Yeah.
And
I'm trying to, as a MFI, I'm going to try to say, okay, what could I make out of this? So one thing is that it's about giving a loan or not giving it, but it's also about giving an amount and a duration, etc. So, and I don't think the test is going, so the test, what I mean is that the test only tells us about the person, but actually assessing for the loan is the person, and everybody has mentioned how important that is, but it's not only the person, it's also the business. So I don't really believe in a situation where we would use only the test to do the full decision. So
that's not. I skipped, and it's not what we're doing.
I imagine that's not what you're saying. So, but what I see, I find it a very interesting tool to assess this person-wise aspect as a complement to other things. But then for me, in microfinance, it's really a question of productivity. So how much time are we going to invest in loan origination based on the size of the loan? So the problem, what's not clear for me is practically how much time does it take for the person to take the test? Do we need somebody next to the person explaining him or her to make sure that things go well, and how much time does it take compared to the one I know I'm familiar with, loan process loan appraisal, where you go, you spend around an hour asking a lot of questions about the person, the business, the financials, etc. So I think it's very interesting because it's probably better than what we're doing today on the client part. But then how much more time would it take? And could we think of something for first cycle borrowers where this would be the first step to do first screening before we invest more time in analyzing the business. That might be a way to think about it.
Yeah, exactly. And in the interest of time, I went really quickly, but I think that's exactly the model that we were sort of using, so that we used it as a first screening device. And if you're not above a cutoff, you're out. And then if you're above a cutoff, you're worth screening. So that's where a lot of the use case came from. Something I also didn't have a chance to mention there is that nonetheless, even above the cutoff, we see that the score is still predictive of whether you default, which kind of surprised me. We ended up with a small sample, really a handful of loans go bad, and still this score among those who score highly is still predictive.
Psychometric score.
Yeah, which surprised me, but exactly, that's a good part of the rationale for, firstly, why we incorporated it that way, and secondly, why we didn't strip out the business appraisal, the documentation, the checking the business fundamentals, because that also determines the ticket size.
How long did it take to do this?
To do the test, like 25 minutes,
25
something
minutes,
like
and
that.
they did it on their own.
Yeah, you didn't need a heavy degree of supervision, but still there's some kind of, you sit in that room and do it. You're not, on the phone to someone or something like this. In principle, you could batch people. That was not typically the way that people came in and applied for a loan, but in principle, you could have a testing session.
And how long would it take for the loan officers to use that data in their process?
Yeah, the score comes out straight away. So, and then following up in the documentation took a few days, or I think the loan that was granted came like a couple of weeks after.
And it gives you a number.
It gives you a number.
Basically,
It gives you a number, yeah.
I mean, it's interesting. There's obviously a wide array of what microfinance is, and as we've discussed all day, it's not. These are not all apples to apples comparisons, and so it's worth knowing where we are here. So, ABA is quite an. They want to only lend with businesses. They go to the businesses. They know the businesses. Each firm has their own loan officer, and the loan officer is not, across 1,000 people. They're all individual loans. And so even within that, what we do is we take the firms, so the loan officer has 100 firms. We ask them to recommend 10 firms that they think could take a larger loan. They then go through ABA's basic vetting process, and then we get that small slice that's gotten through. This is what we think of as the group that ABA currently thinks is, on the cusp of somebody that could go and do well, but they're still not willing to lend to them. And then we're experimenting with that group. But when they come in, they sort of have to sit down with the loan officer again and explain what they would do with that loan, which is a relatively long process. Specifically, definitely given the size of the loans. And our add-on then is to ask them after that to simply come and sit in front of a computer for, I think it is the same, about 25 minutes. So the time that takes, given that you've come to an office, is sort of rather minimal. But obviously, if it was first origination, microfinance in a rural community, the cost would be much higher.
Ronnie, where's the mic? Yep, there you go.
Thanks. So I have a question on biases and psychometric testing, and because we did hear a lot today about how important the entrepreneur is, and I think I share some of your skepticism as to how important it should be, so the element, because a lot of those characteristics tend to be Eurocentric, and I'm curious as to whether and how the biases with this black box would be different. Is it more? Is it less? What does it look like?
Yeah, so, and point taken. And I mean, firstly, when it comes to gender bias, we have an all-women population, so it's trained only on women, so there's no scope for it to, to bias against women. Just to stress that this, I think the original set of questions is taken from the US, but this was first used commercially in Kenya, then it was piloted with an Ethiopian MFI and so on. So the model is completely trained for the local context in terms of predicting default. So it's not taking into account how it would predict default in any other context. So hopefully that speaks to your point. But Gharad, did you want to add anything, especially on gender and?
No, I mean, I think there are known ways to get around the gender bias that I highlighted, and it just requires more data. If you train separately on a female and a male sample, you should be okay. I'm 90% sure that what I just said is true. Because bias can sneak into these things very easily. We are not in any way using anything that's trained on a European sample. And I think that would be something that people might want to be tempted to do, is to just sort of train it once on one sample. And I think that's a recipe for disaster. And I think that's what's going on in a lot of different places. So you have to be very, very careful about these sorts of things. And all of that, again, will add to the cost of getting this right to actually do it.
Patty, oh, okay. We have one back there. And then.
So trying to pull something from earlier today, given the heterogeneity, right, wouldn't the optimal product be to take the people at the high end and put them into equity-like products and not lend to them? And is there a pathway of bringing these things together that says you're sort of identifying the people who are your equity borrowers versus your debt borrowers versus the people you should actually stay at this level? But I also just wanted to follow up on that, the women bias question, really, because I think what you said is that the overconfident were the ones who did worse. And so my expectation would be, oh, it must be biased towards women because women typically are not overconfident compared to male samples. So is there anything more about that you know about where that's coming from? Because the women generally would be less confident?
Yeah, I had the same question, actually.
Have you ever tried to play with one of these models and try and make sense of what's going on? I mean, I think this is down to the black box problem of it. It's very, very challenging. Everything in the model turns out to be correlated ex post. And finding out what's causing that is extremely challenging. So in the cross-section, being a woman doesn't tend to predict these kinds of answers to the question, but the model still says in the lower group, there's a higher proportion of women than in the upper group. So I struggle with that. And the equity question, I think, is, I want to highlight one other thing which maybe is lost in the psychometric thing. And it's my most interesting thing about the work we did, is just there is this heterogeneity. Like, it's not the case that the average microfinance borrower can go on and really grow their business. And we were probably silly to imagine that would be the case. Once we discovered that and convinced ourselves, the next question is there a subset? And what I feel most excited about is the idea that there is a subset. I'm less wed to the idea that the way to find them is psychometrics. And if the way to find them is to make some more equity stuff available, which means it's therefore of value for an individual to sit carefully with the entrepreneur. Now, that seems, an alternative thing that you could learn. I mean, the business plan stuff didn't work, though, did it, Chris?
Well, my takeaway from the business plan stuff generally, the small scale business plan, small scale firm business plan competition kinds of things that we've run is, you can cut off the bottom tercile, the bottom third. You can predict who the losers are, but you can't predict who the winners are. And so, it's not that it's not helpful at some degree, but it's not. It's not allowing you to pick who the winners are.
Just to add on the equity point, I mean, I agree with the sort of first order thought that if we can predict returns, then we might want to be thinking about equity products. But I just want to stress that, in my context, we're using psychometrics to predict default, and that is it. And so we can't say anything about how people might behave, and the ordering might be completely different if they received equity investment. And I believe in your work you show that predicting who has the highest returns to small loans versus larger loans is different. And so I wouldn't be confident to say those who had the largest returns to how that model could predict who would perform best under equity investment. And we saw in Mohammed's work, that it might be a very different profile of people that would even demand that product and how they would invest it and what the returns would be. So
there's something weird in our data, which is worth having a think about in terms of who can predict what. Is the firms that do very well with the large loans are firms that grew relatively slowly with their initial borrowing. They are careful, methodical entrepreneurs. But ex ante, I would have said that those aren't the sort of people you want to give big loans to. And I would worry that, well, that's exactly what most of the loan officers would think. Which of my firms is growing fastest? we're waving our hands in the paper a bit, but our interpretation of this is, look, there are people who are really gung-ho to do these kinds of things. Eventually, they're going to grow to the scale where that is not going to work out for them, and there's sort of a more careful, methodical approach of thinking what you actually need this money for and using it well is better. So that's down to the question of whether it's actually easy to predict these things as an individual, and what sort of data you would actually need to do this.
I think, to me, what's surprising is not that there's heterogeneity. What's surprising is that people don't know that they're not going to benefit from the larger loans. They can't predict their own heterogeneity in a way.
My main comment about this, I used to think that way. But then if you look at data on small business ownership in the US, it's fully 50% of firms go out of business in the first year that they open.
Yeah.
So those individuals have taken out loans, they've opened a business, put in some of their own income, taken the year off work, earned nothing, and gone out of business. If we looked at their financial diaries, they'd be much worse off because of the loan. If you'd stopped the loan, they'd be better off. And so, then, look, it seems less strange.
These aren't firms in the first year, though. These are firms that have been around for a while.
I still think that happens every time you try and expand, right?
Fair enough. Fair enough. You had something more online. We should.
I was just wondering whether there was any crossover with Mohammed. You're thinking on risk preferences,
I think it's in there where he doesn't want to dive too deeply into any particular component. So you had risk tolerance, right? But it's still black boxy, so you don't want to speculate.
No, our risk-tolerant people are the people who do badly. Our slightly more risk-averse people do well.
Risk-averse do well.
Our slightly more risk-averse people do well with the loans, consistent with this story I'm telling you. It's also like we have cognitive tests, and the people who do well are people who have what would be traditionally thought of as a higher IQ through various different tests. I'm not too excited about that. There's all sorts of worries around that as well, but